Good day, fellow investors. Pool Corp analysis. There have been a lot of comments about Pool Corporation, Buffett is buying it. You can see here the purchases Warren Buffett and Berkshire did. They have about 3.5 million shares. What's that? 10% of the company, which makes it interesting. Also, some emails received here from Stefano. Attractive valuation, P ratio of just 22 compared to the even 40 in the past. Recurring revenue, maintenance of pools, not just building pools, so more resilient during downturns. Good dividend, buybacks, that's shareholder friendly. Berkshire owns stake, so they have also increased it this year, even in the stock is going even lower. Predictable cash flows, first position, that's a moat in the market leadership, growth potential globally. Weakness currently creates an opportunity to add this business to your portfolio. The business, mainly focused on the US, but they have started expanding in Australia and Europe. If they can scale this too, that is also room for growth long term. However, still they are just US. Now, the key here is 64% maintenance and repair, renovation, remodeling, and just 14% of the business is new construction. So when new construction crashes, the business should survive. Let's look at the last earnings. The Pool Corporation dive in. Wouldn't you like to jump into this pool? The pool costs more than the house here. Okay, now here there is a bigger house. So okay. Flattish, okay, still profitable, great gross margins, everything good margins there. And you can see here, as interest rates started going up, as people had less free money, of course there were great difficult comparables before that when everybody was buying a pool, but now we are flat, however still profitable, still good margins, everything okay, good balance sheet. They have the money to reward shareholders. What's that? 3-4% yield, 5% shareholder yield. For now, everything looks flat. Earnings per share 10 to, let's say, $11 per share. $11 compared to this P ratio of 20, nothing wrong. However, here we must look at consumer spending and, of course, interest rates. Because when the mortgage rate is 6%, we are far from this booming. How many times have I told you here to take a long-term fixed mortgage rate? Many of you have done it. Great. However, now buying a house costs twice or 3 times more when you look at your monthly payments. Plus, home prices went up, so it's getting crazy. Also, they said in the conference call they would need these low rates to see a pickup in pool and spending. But okay, let's do a pool stock valuation. If you look at the business, the trend is clear, then there is a little bit of a decline, but still resilience. These guys remained profitable in 2009. This is over trend, I think, and I think this will be the trend. So something like this, over trend, so 300 profit here on the growth there. 300, they are using it to pay the dividends. Maybe they'll have to cut a little bit on the repurchases. 300, that's 4% yield, earnings yield. And now the question is, what is the growth at that 4% current return to shareholders? Downgraded at William Blair as high interest rates impede construction, so we have not yet seen a normalization. However, they still have a 305 share price there. But when we look a little bit at the conference, it will take further reductions to bring borrowing rates to a level that will motivate potential entry-level pool owners to build. There are some signs of stabilization, but what do you see in the housing market? How do you see summer, fall? Nobody can know projections into 2026. We'll have to wait for that. There is also some weakness in the chemicals, and that is also part of their core or things like that, sales and margins. However, everybody thinks that the market will keep on growing for 11%. Wow, going forward. The number of pools has been going, as said, these are difficult comparatives, so should be a little bit more stable. Again, the margins, extraordinary things. This will normalize to a 5, 6, 7%, 5%, let's say in pool time downturns, recessions, 5, 6%, that's earnings per share of 8, 5% growth going forward. That's a P ratio of 12. The stock valuation for me is 96. Now you're thinking, I know you're already, Sven, you value investing idiot. If your target is 96, why did Warren Buffett buy at 300? I have no idea. Maybe because they own Clayton Homes, they wanted to offer first start, learn the business, connect with the management, and perhaps later in the future, just buy it outright out and then say, okay, let me do a deal there. Maybe it's from Ted or Todd that they are maybe planning on doing those deals long term, or from Clayton Homes, or you never know. But yes, the average buy price was around 300. However, a video I will leave you to watch is just 3 minutes, but Warren Buffett sells 9 out of 10 of his first investments. He buys them, learns about them, and only one of his investments at Berkshire become a long-term forever hold. Everything else is sold over time, recycled, whatever. So be very careful when it comes to looking at Warren Buffett's purchases. The question, why did he buy Google? I have no idea. Perhaps it was cheap in July at a P ratio of 20 and they said, okay, let's spend 5 billion on it. It's not 50 billion, so we'll see what happens next. Thanks for watching. I'll see you in the next video.